Here's a question for you. When one of the most successful investors of all time starts selling shares of a company that's been dominating the electric vehicle market, does that mean it's time to panic? Or is there more to the story? Today, we're diving into Warren Buffett's decision to reduce Berkshire Hathaway's stake in BYD, one of China's most innovative EV giants. If you've been following the EV industry, you know BYD has been on a meteoric rise, but Buffett's recent moves have raised eyebrows. What's behind his decision? And what does it mean for BYD and the future of electric vehicles? Let's rewind the clock to 2008. The world was in the middle of a financial crisis, and most investors were scrambling to cut their losses. But not Warren Buffett. True to his style, Buffett was looking for opportunities to buy undervalued companies with strong long-term potential. That's when BYD caught his eye. At the time, BYD was a relatively unknown Chinese automaker with big ambitions. They weren't just building cars, they were developing their own batteries, which gave them a unique edge in the growing EV market. Buffett's investment arm, Berkshire Hathaway, decided to take a chance, buying a 10% stake in BYD for $232 million. It was a bold move, considering the skepticism around EVs back then. Fast forward to today, and that $232 million investment has ballooned to over $7 billion. That's a return of more than 30 times the original investment. BYD has grown into a global powerhouse, leading the EV market in China and even outselling Tesla in terms of total EVs delivered last year. The company's success has been driven by its innovative blade battery, diverse lineup of electric cars, and aggressive expansion into international markets. But despite BYD's incredible growth, Buffett has been steadily selling his stake in the company. Since mid-2022, Berkshire Hathaway has reduced its holdings in BYD by more than half. So what gives? Why would Buffett cash out of such a successful investment? First, it's important to understand Buffett's investment philosophy. He's known for being a long-term investor, but he's not one to hold on to a stock forever. When an investment reaches its full potential or its valuation becomes too high, Buffett often sells to lock in profits. And let's be real, a 30x return on investment is hard to ignore. Another factor is diversification. Berkshire Hathaway manages a massive portfolio, and BYD's skyrocketing value likely made it a disproportionately large part of their holdings. Selling shares helps balance the portfolio and reduces risk, especially in a market as volatile as EVs. But there's also the question of BYD's future growth. While the company is still thriving, it's facing increasing competition in both China and international markets. Tesla, NIO, and other automakers are all vying for market share, and BYD's dominance isn't guaranteed. On top of that, geopolitical tensions between the US and China could create challenges for Chinese companies looking to expand globally. Lastly, there's speculation that Buffett's decision might be influenced by valuations. BYD's stock price has surged in recent years, and some analysts believe it's now overvalued. Selling at these levels allows Buffett to maximize returns while the stock is near its peak. It's worth noting that Buffett hasn't completely exited his position in BYD. Even after selling a significant portion of his shares, Berkshire Hathaway still owns a sizable stake in the company. This suggests that Buffett still believes in BYD's long-term potential, but is simply taking a more cautious approach. While BYD's growth story is impressive, its financial structure raises some important questions. A recent report by Hong Kong-based GMT Research highlights concerns about BYD's increasing reliance on supply chain financing, which may mask its true debt levels. According to GMT, BYD's reported net debt as of mid-2024 was 27.7 billion yuan. However, when adjusted to include receivables that have been sold or borrowed against, as well as payables exceeding 90 days, BYD's actual net debt could be as high as 323 billion yuan, or $44.1 billion. That's a staggering figure, especially considering the company's market value of around $105 billion in Hong Kong. What does this mean for BYD? Essentially, the company has been using supply chain financing to manage its cash flow. This practice allows suppliers to receive early payments for invoices by paying a fee or to wait longer for payment. While this isn't uncommon in the industry, BYD's extended payment periods, averaging 275 days in 2023, are far longer than the 45 to 60-day cycles typical for automakers in other parts of the world. This raises concerns about liquidity and financial stability. The lack of transparency around BYD's other payables category, which ballooned from 41.3 billion yuan in 2021 to 165 billion yuan by the end of 2023, makes it difficult for investors to assess the company's true financial position. While BYD's reporting complies with accounting rules, the complex nature of supply chain financing creates uncertainties about its liabilities and cash flow. GMT's report also highlights how BYD's financial practices affect its suppliers. Some suppliers borrow against the money owed by BYD, essentially using the automaker as collateral. However, this system, facilitated through BYD's Dilink platform, has sparked questions about how it's treated in financial reports. For instance, stock exchanges in Beijing and Shanghai have queried suppliers about their accounting for Dilink-related receivables, further underscoring the complexity of BYD's financial arrangements. While these issues haven't derailed BYD's growth, they do pose risks. Investors need to consider whether the company's reliance on supply chain financing is sustainable, especially as competition in the EV market heats up. Now, let's talk about what Buffett's decision means for BYD. First off, it's important to remember that Buffett's actions aren't necessarily a reflection of BYD's performance. As we've discussed, this is more about portfolio management and valuations than any fundamental issues with the company. That said, Buffett's move could have some implications for BYD's stock price. When a high-profile investor like Buffett starts selling shares, it can trigger a sell-off as other investors follow suit. And that's exactly what happened when Berkshire Hathaway began reducing its stake. BYD's stock experienced some volatility, but it's important to keep things in perspective. The company's fundamentals remain strong, and its long-term growth story is far from over. In fact, BYD is still expanding aggressively. The company recently announced plans to build factories in Thailand and Vietnam, further solidifying its presence in Southeast Asia. It's also making strides in Europe, launching new models like the Atto 3 and entering markets like Germany and the UK. These moves are part of BYD's strategy to become a truly global brand. But with growth comes challenges. BYD's expansion into new markets means it'll face increased scrutiny over things like quality control and labor practices. Additionally, its reliance on the Chinese market could be a double-edged sword. While China is the world's largest EV market, it's also highly competitive, and regulatory changes could impact BYD's operations. There's also the question of innovation. BYD has been a leader in battery technology, but the EV industry is evolving rapidly. Solid-state batteries, wireless charging, and other breakthroughs could disrupt the market. BYD will need to continue investing heavily in R&D to stay ahead of the curve. So, what can we learn from Buffett's decision to reduce his stake in BYD? For one, it's a reminder that even the best investments have a shelf life. No company can maintain explosive growth forever, and smart investors know when to take profits. It's also a lesson in diversification. BYD's success made it a significant part of Berkshire Hathaway's portfolio, and selling shares helped balance the risk. This is a strategy that individual investors can apply to their own portfolios. If a single stock becomes too dominant, it might be time to rebalance. Finally, Buffett's move underscores the importance of valuation. BYD's stock price has soared in recent years, and some analysts believe it's now trading at a premium. While this doesn't mean the company is doomed, it does suggest that future returns might be more modest. Warren Buffett's decision to reduce his stake in BYD has sparked plenty of speculation, but the reality is simple. This was a smart financial move for Berkshire Hathaway. BYD remains a strong company with a bright future, but even the best investments need to be managed carefully. For BYD, the road ahead is full of opportunities and challenges. The company has proven it can compete with the best in the EV industry, but it'll need to stay innovative and navigate an increasingly complex global market. So, what do you think? Was Buffett's move a signal to take profits, or is there more to the story? Let me know in the comments below, and don't forget to like the video if you enjoyed this breakdown. Thanks for watching, and I'll see you in the next one.